Hello, everyone. Welcome to the 25th episode of Money Minutes. I am your host, Zak Gardezy. I'm a certified financial planner and the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. So here on Money Minutes, I cover the latest market headlines and my outlook for what's ahead. And there's a lot to cover on this week's episode, so let's get right into it. So thousands of dock workers represented by the International Longshoremen's Association are on strike. Now, effectively, it's blocking imports and exports at major ports around the United States.
In the meantime, we turn to the economy tonight and to this crippling strike. Tens of thousands of union dock workers up and down the East Coast and the Gulf walking off the job, threatening the nation's supply chain and, of course, then the prices you could potentially pay.
Now, President Biden has decided not to invoke the Taft-Hartley Act. It's a law that could force these workers back on the job, and it's a risky political move because it's just weeks before the 2024 election, and Biden's positioning really himself as the most pro-union president in history, and invoking the Taft-Hartley Act would clash with that message. But without it, the administration has limited tools to intervene here. So for context, back in 2002, President George W. Bush faced a similar situation, but on the West Coast. Now, Bush did invoke the Taft-Hartley Act to reopen the ports, and he kept goods moving. Now, he was citing national economic interests as the reason for why he did it. Biden's refusal here might mean we're in for some serious ripple effects. Now, in the near term, experts estimate that the cost to the U.S. economy is about $2.1 billion per week. Now, we could see some shortages of products like seafood, alcohol, and even bananas if this continues. Now, long term, if negotiations drag on, it could seriously affect supply chains, retail inventories, and inflation, all things we don't need more of right now. Now, let's just hope both sides can come to an agreement soon because really, that's just going to create a lot of risk for the overall economy if we can't come to a resolution in short order. So on October 1st, Iran launched a massive missile strike on Israel.
Good day. We are coming on the air with breaking news from the Middle East. NBC News has just confirmed that Iran launched a ballistic missile attack against Israel that began moments ago. Those missiles heading directly toward Israel right now, anticipated to reach its territory in just a matter of minutes. These are live pictures of Tel Aviv.
Iran reportedly fired 180 missiles, including drones. Now, Israeli defenses claim to have intercepted most of them, but the effectiveness of the strike has been disputed by both sides. Now, this attack is part of a broader escalation that has Israel fighting on multiple fronts. And really, quite frankly, tensions have been mounting for weeks, especially after Israel assassinated some key militant leaders. Now, the strike led to bomb shelters filling up across Israel, while Iran, for its part, claimed that this was a legitimate response. Now, adding to the complexity, the U.S. showed full support for Israel, even firing interceptors at incoming missiles from two destroyers in the Mediterranean. Now, the Middle East is in a highly volatile state, and any misstep could lead to an even wider conflict. The risks of escalation are real. For example, if the Strait of Hormuz, which is a crucial shipping route, were to be closed, we could see serious disruptions in global energy supply. There are also fears about Iran's nuclear ambitions. If Iran is close to developing a nuclear weapon, it could dramatically shift the balance of power and provide even greater instability. Plus, if other regional countries were to get involved, we could see a spike in oil prices, which would, of course, ripple through the economies worldwide. So for, market volatility so far really hasn't spiked up much compared to, earlier escalations this year, which is showing that maybe investors aren't as concerned anymore about the risks, or we're all just getting used to the same tit for tat between Iran and Israel. But nonetheless, geopolitical risks remain. And quite frankly, as I've been talking with clients about, throughout the year, it's a time to remain cautious when thinking about investing internationally. But I'll be watching the situation closely and stay tuned for more updates on this front. So shifting gears back to the U.S. economy, Federal Reserve Chairman Jerome Powell delivered remarks this week at the National Association for Business Economics in Nashville, Tennessee. He provided some key insights into the U.S. economy and interest rates. Powell emphasized that the economy is in solid shape with strong hiring and inflation's down to 2.2%. He noted that the Fed is recalibrating its key interest rate, which is at 4.8%. aiming to bring it down closer to the neutral rate of about 3%. Now, the neutral rate is the level of interest that neither stimulates nor restricts economic activity. It's really a balancing point. And since the current rate is above that level, it implies more rate cuts are likely if the economy continues to evolve as expected. Now, Powell was clear. The Fed isn't on a preset course, and that future decisions, quite frankly, are going to be made meeting by meeting. Now, the recent half-point rate cut, it was part of the Fed's confidence in balancing economic growth while reducing inflation. Powell also made it clear that the committee isn't in a hurry to cut rates too quickly, which is reminding us that there are risks on both sides. So, wrapping things up, the port strikes pose a serious near-term risk to the economy and the overall stock market. Every week that goes by, it'll cost the U.S. economy billions of dollars, and it could cause mass layoffs, higher inflation, or even more dire circumstances for the economy. This could even cause the Fed to skip a rate cut, which would severely hurt a market that's already priced in 3 rate cuts this year. Now, the Biden administration needs to take an aggressive stance on making sure both sides of this strike come to some sort of an agreement quickly before the economy sees some serious damage. From a political perspective, the Biden-Harris administration will want to avoid this strike taking too long to resolve, because if they have to force workers back to work with the Taft-Hartley Act, then that will surely not bode well for them this close to the election. However, a swift resolution brokered by the White House would look like a massive win for the administration, and therefore the political and economic stakes are extremely high. Now, on the geopolitical front, as I've talked about all year, tensions in Europe and the Middle East continue to escalate. And if you're someone looking to invest in international markets, you're probably taking on way too much risk, in my opinion. These wars are so critical that, frankly, any further escalation is going to impact the entire world. But I will continue to focus client investments at Wealthstone in large cap U.S. stocks, which continue to outperform most other areas of the market. I don't see any other reasons why really either war would de-escalate based on the latest developments, so therefore investors should remain cautious. Now, moving on to Powell's comments about rate cuts, this should be seen as a positive for the markets. Every time the Fed chairman goes out and speaks positively about the economy and the potential for more rate cuts, we should breathe a sigh of relief. As I've mentioned before, the Federal Reserve will begin to act a lot like the European Central Bank, which cut rates earlier this year. Future rate cuts are going to be dependent on data, and the decision to cut rates could change really on 1 or 2 bad economic reports. Therefore, the Fed's comments and meetings are going to still be highly scrutinized. Now, the next Fed rate cut is expected on November 7th, just a couple days after the election. And based on everything going on domestically and around the world, the next 4 to 5 weeks are going to be full of surprises and extremely volatile, in my opinion. And remember, interest rates are coming down, so continue to review your savings and money market accounts and begin to look for potentially other places to invest long-term capital. Depending on what happens this month, that could mean dollar cost averaging into the stock market or putting money to work in the bond or alternative investments markets. So for anyone sitting on large amount of cash or just unsure of how to get in, or someone who's just concerned about how to navigate this market, please don't hesitate to reach out. Now, this concludes this week's episode of Money Minutes. Thank you so much for tuning in, and I hope to see you all again next week.